Welcome, everyone. I'm happy to get us started today for our presentation on the PPP program and the loan forgiveness. Before I start, as you can see sitting next to me is Jim Brown, and so I wanted to welcome Jim and thank him and the Montana Independent Bankers for helping us host this today. So I'm going to hand it over to Jim really quick so he can say a few words.
Thank you, Angie. I just happen to be at AZ at this moment. I'm actually over here. We're doing the audit for the Montana Independent Bankers right now, which is why I won't be on the call, but it just worked out well that I happen to be in the AZ office. I want to thank Angie and our partners, Anderson Jamullin, for co-hosting this event. We appreciate your associate membership in the MIB, and we're glad to be your partner. And I hope everyone on the program today has a productive experience and finds this educational, and thank you for everything you do for community banking, and let me thank you for the Herculean effort that all of you engaged in to get this PPP program off the ground and running. It's truly amazing and a reflection on how great banking is in the United States, that the government can create a program out of whole cloth and have it up and running in 2 weeks, and they couldn't have done it without community bankers across this country. So thank you for everything you do, and Angie, thank you.
You're welcome. Thank you.
Okay, I'll take my leave. Back to the audit.
That sounds a little bit more fun, maybe.
A little bit.
Well, thank you, everybody, for being here. I appreciate your attendance, and I just wanted to again say thank you to the MIB and to Jim Brown for being willing to help co-sponsor this so that we could provide this information to you and be able to hopefully give you a little bit of clarity on looking at the Paycheck Protection Program for the loan forgiveness application. Just a couple quick housekeeping items. It looks like everybody is on mute when you came into the call. I know Asia in our office immediately muted you. If you do have questions, we do have the ability for you to chat in a question, and myself and Megan will be monitoring those during the webinar when we're presenting, and we'll kind of take turns presenting throughout this. And so go ahead and chat in any questions you have throughout the whole thing. And then we will, at the end, have about 30 minutes that we are dedicating just to those questions, so we can try to answer as many questions as possible. If we don't, for any reason, get to all of the questions, we will send out a follow-up written Q&A based on the questions we do receive. But if we're able to do them all on this call, that would be great. But otherwise, we will follow up in any ones that either we don't have an answer to, or any that we have an answer to but just haven't gotten to. We'll make sure to follow up on those. So a few things I wanted to introduce the speakers, which myself and Megan are the people that will be presenting today. So for myself, I, as I said before, am Angie Murdo, and I've been at AZ for about 18 years now. I work solely in the attest department, specializing in audits, fraud exams, consulting, and a lot of that work is done for financial institutions and then some other private and public entities as well. And I am the lead on our financial institution team, and then also a member of the firm's newly established PPP team as well. Megan Connors, who generously was willing to do the majority of the presentation today, she is in the attest department as well. She has been with AZ for about 11 years now, and she specializes in audit and consulting work in healthcare, nonprofits, governments, and then some other private entities as well. She is also on our special PPP team, and she's also a member of the nonprofit specialty team. And so I think that one thing that you guys will see from this is we did put together a specialty team dedicated just to these PPP loans because they were such a huge deal, and because there's so many of our clients and other people here in the state of Montana that have been trying to figure out what to do and how to work through them. And so we just wanted to do the best as our firm to make sure that we could give you the best information and the most current information possible as everything has been coming out through this process. So I know 90 minutes is a long time, and hopefully some of you are maybe eating your lunch or anything, but we really want you guys to know that a lot of this information is really important, and we're going to do the best we can to try to make sure that we can help you keep your focus for the full 90 minutes. Like I said before, the first 60 minutes will be just a presentation, and then we'll do some Q&A after that and as we go along. And so please submit your questions if you have any, if there's anything that we didn't answer, or even as we're going along and you're not sure if we will or not, please submit those into the chat and we'd be happy to go through those. So one thing, just to give a word of caution, we do expect more guidance. I think if any of you have been going through this program, you obviously know that it's a moving target. Things haven't stayed the same since this program came out. They've been putting out Q&As, they've been putting out additional guidance through the treasury.gov, through the SBA website. There's a lot of information out there. And so with that, and with the new legislation that just passed on Friday of last week, we anticipate that there's going to be even more information coming out. So the information we're giving you today is as of the information that is out now, but we're hoping to get more guidance from the SBA, and our firm is going to hopefully send out more information as that comes out so we can keep you informed if that does make any substantial changes. We are expecting an additional loan forgiveness application to come out with the updates from the SBA as well. So we'll go through those and what we expect them to look like with this webinar, but just be aware that with how much this is changing and how quickly it's changing, it is hard to know where some of that guidance might be. And just so you are aware, there are some things that at this point, there still is not enough set guidance to really interpret some of what is actually within the Act. So hopefully that information comes soon, but I just wanted to give you kind of a word of caution from that perspective. So what we want to go through is, one of the first things is just, what the practical guidance on understanding and preparing the application. Everybody went through and applied for their PPP loans over the last several weeks, were accepted and funded. And so now a lot of people, starting, I think last week was the first week when people met what was originally the 8-week timeline. And so they started needing to fill out these forgiveness applications. And now that that's been extended, which we'll get into more later, it's something that we'll need to talk about. What does that mean? How do I need to prepare this? And how is that going to happen? And so this is information that I think it's still coming out, but it's stuff that people really need to know now so they can start working on their forgiveness applications. Even though they already received the funds, it's good to know. You want to know, am I going to be forgiven? Do I have to repay any of this? If I repay it, what is it going to look like? And so we'll go through that throughout the slide and show that and explain that to you. So one of the key points that we want you to know is there are a few unknowns, but there are some that when some information came out with the first draft of the forgiveness application, that it did clarify some points. So it was the Treasury Department and the SBA that released that first draft, and it's supposed to help the borrower obtain your forgiveness and determine how you truly need to calculate that. And one thing to be aware of is, yes, a modified version of is expected to come out because of any changes that were made by the new act from Congress last week. We're hoping it's going to come out any day. They really do need to get this out sooner rather than later because of the fact that people some of them have what they feel meets enough of expenses to get full forgiveness, and they want to be able to apply for those as soon as possible. And so we're hoping that that will come out any day now. So some practical guidance. Couple things that I wanted to go through is, one of the things is the form that's out there now. Some of it will change, but I do still think it's worth reading, going through the form. It's not overwhelming. You know, it's not the same as reading the entire CARES Act, which is hundreds of pages long. It's got great definitions in it. It does a good job of guiding you through how to fill it out. It's worthwhile, even if you plan on having somebody else help you complete the form. I still think it's something that's really worthwhile having you go down and sit and read through it. It's 14 pages long. It's not difficult to read, so I do encourage that. The other thing is, have your CPA help you, or your accountant, or somebody that you know who understands the PPP loan and what the requirements are. They are going to help you and guide you through this. Yes, there still are some areas that are considered shades of gray that don't have exact clarity and guidance at this point, but they're going to be able to help you know what you do know and what you don't know, and things that maybe that you were planning on doing that could potentially be incorrect or help kick your loan back out, so you have to start over again. You want to make sure that when you fill this out, you're filling it out completely the first time. You don't want to have to go back because there were errors in it the first time you did it and start over again, because that is going to be a big delay on whether or not you get the forgiveness. So you want to make sure you are very careful about filling this out correctly the first time. So if you're not comfortable with the PPP, as noted, just make sure that you are having somebody help you fill it out. And as I said, just do not do anything that you think is a guess. You want to make sure that you're doing it correctly. And from there, so this is kind of the overview, kind of the areas where I wanted to just go out and say, you know, just make sure that everything that you're doing, that you're really thinking about what it means and how it will affect your forgiveness. The forgiveness piece is really important to this. If you received a loan, it was because you needed it. It was because you wanted it to use to continue your business during the pandemic, and you want to make sure that you do everything you can to get 100% of that forgiven. So just keep that in mind. And at this point, I am going to turn it over to Megan, and so I'm going to quickly have her take over the presentation, and then she will get started from there. Okay, I think she should.
Thank you.
You bet.
Yep. Thanks, Angie. Okay, so first and foremost, for any of you guys that did have some basic knowledge of what the PPP program looked like prior to last week, I wanted to jump in and just summarize the key changes that happened with the Paycheck Protection Program Flexibility Act. So Friday, this act was signed into law. You know, it included some key changes, which most of them I'm going to go over in much more detail, but just wanted to summarize them first here. So first and foremost, it did change the minimum maturity of the loan repayment for amounts not forgiven to 5 years versus 1 year. Then on Monday, June 8th, SBA and Treasury did come out with a statement stating that this increase for 5 years is for PPP loans that were approved on or after June 5th. And that June 5th date is based on the date that the SBA assigns a loan number, which is not the date that the loan was dispersed, it's the date that they assign the loan number. Hoping to hear some more guidance from them to verify that this is accurate, because that's not exactly what was written into law. So while that information is out there, I would like to just caution everybody that hopefully that might possibly change. The next change from this act was that it did allow a covered period up to 24 weeks. That being said, if you had a PPP loan that was approved prior to June 5th and you received your funds, you are still allowed the option to use the original 8-week covered period. The next key change was that there is a reinstatement of wages or FTE reductions for that safe harbor provision up to December 31st, 2020 compared to the June 30th date. There's additional exemptions for the FTE reduction based on certain employee availability, and we'll go through those in detail. The non-payroll costs increased from 25% to 40%. And then this last bullet point, after some further research this morning by Angie and I, will change. That last bullet point regarding the extension of the deferral period to 10 months after the last day of the covered period is only for borrowers who do not apply for any forgiveness. If you submit a forgiveness application, your deferral period will be based on the date that the SBA remits the forgiveness amount to your lender. So you apply for a forgiveness application in July, SBA has, the lender has up to 60 days to determine whether they approve your forgiveness amount, and then the SBA has up to 90 days after that to determine whether or not they're going to approve the forgiveness and submit the funds to the lender. So it's all kind of depending on when you submit that forgiveness application on when your possible deferral, if there is any that was not forgiven, would end and you would have to begin making payments. So let's go over some key definitions here. Cash compensation. Obviously, the biggest piece of this PPP program is for cash compensation because payroll costs have to be the majority of what you spend these funds on. It includes gross salaries and wages, tips, commissions, paid leave, and very important to note that any paid leave that is being covered by the Families First Coronavirus Response Act and you are receiving a credit is not eligible as an amount for the cash compensation for the PPP loans. And in addition, any cash compensation for employees may not exceed $100,000 annually as prorated for your covered period. We have received lots and lots and lots of questions about what it means for gross salary and wages. It is what it is. It's gross salary and wages. No reductions for any withholdings, deferred compensation, HSA contributions, anything like that. It is literally the employee's gross salary or wages. Another key definition is average FTEs. The definition of this was not clear until they submitted that first draft of the forgiveness application. And average FTE is calculating using actual hours for each covered pay period, but not exceeding 40 hours for any employee. So if an employee works over 40 hours, they're an automatic 1 FTE. So for the remaining part-time employees, you would divide their hours paid by 40 per week, and then round to the nearest tenth. There is a simplified FTE method, which would allow you to assign 1 for each employee who works 40 hours or more, and then a 0.5 for each employee working 40 hours or less, essentially just to decrease the administrative burden if you have employees that haven't really changed what they're working. And then we do need to talk about the salary and hour reductions. So there's some possible reductions to your forgiveness amount for an employee's salary or hourly wage during the covered period compared to different reference periods. So essentially for the wage reduction, it is the first quarter of 2020. And then the second thing to note that if you can restore that employee's wages, if you reduce them for some reason after February 15th, if you restore them by December 31st, there's a safe harbor. You don't have any reduction for that. Additionally, if you didn't reduce any employee's salary or hourly wage by more than 25% during that covered period, then there won't be any impact on the canceled debt. So here's some really key documentation amounts and dates that you'd want to gather, before you start even filling out the application. The key to this is that the documentation is so important because SBA has up to 6 years after they've allowed forgiveness to continue reviewing these loans. These dates and amounts kind of set your guidelines for making your best choices for loan forgiveness. So I think this is the perfect place to start when you're going down this road. So the first one is your PPP loan amount. And you also want to make sure that you're reviewing your bank statements and documenting the date of the loan disbursement because this will matter for your covered period. we'll go into this a little bit further, but you also want to document the first date of the pay period following your PPP disbursement. If you received a PPP loan prior to June 5th, you're going to want to document whether you're going to choose the original 8-week or 24-week covered period, as you now have that option. And then there's also the alternative payroll covered period. So if you are paying payroll on a weekly or biweekly pay period, you're allowed to choose an alternative covered period. And I do want to note that this covered period is specifically for payroll costs only. This does not affect your non-payroll costs. And so that's why you want to document the first date of your pay period following your PPP disbursement. You also want to know the beginning date of your covered period that you have elected. Sorry, it's not letting me change this. And then the ending date. And so you'll probably want to document an ending date for both your original covered period and then also your alternative if you're selecting that as well. So it's still not as simple as all of that. We want to look at some of the options that we've got available. So first off, your 8 or 24-week covered period. If you're getting close to the end of your 8-week period and you're realizing I might not meet the threshold for having 60% of this as payroll costs, I haven't used all these funds because I'm still not operational, I really think you'd want to look at taking that 24-week covered period option if you're allowed to. If you're just getting your PPP funds now, it's an automatic 24-week covered period. That's not to say that you wouldn't have been able to use the funds prior to the end of the 24-week period and begin this forgiveness application, but you are allowed up to 24 weeks. And so this is based on the first day of your covered period must be the same date as your PPP loan disbursement, regardless of when you received it. If you got it on a Sunday at 5 p.m., that covered period begins on that Sunday. So the example here is that, if a borrower received its proceeds on Monday, April 20th, the first day of its covered period is April 20th, and then the last day for the covered period is either Sunday, June 14th for the 8-week covered period, or it would be October 5th for the 24-week period. Option 2, for payroll costs, we can use the alternative covered period. And this is just for, again, borrowers with a biweekly or more frequent payroll schedule, and you can elect to calculate your payroll costs using 8 weeks or 24 weeks that begin on the first day of your pay period that starts following your PPP loan disbursement date. So our example here is you receive your PPP loan proceeds on Monday, April 20th, but your next pay period starts Sunday, April 26th. So for payroll costs, now your covered period begins on April 26th, and it's going to end on Saturday, June 20th for 8 weeks, or October 11th for 24 weeks. So here we talk about wanting to look at your estimates here, and now that they've kind of pushed out this 24-week period, that might not necessarily be necessary, but if you're getting close, at the end of the 8-week period and you want to start estimating whether you're going to meet that or not, just go in and look at your actual and then your estimated payroll, numbers for these covered periods, and then estimate your debt discharge. This is going to help you make some further decisions on, what you're going to do going forward with other costs, other non-payroll costs. What other payroll costs should you be incurring to meet these requirements? So here's where we kind of get into the bulk of really what goes into this application, and it's definitely not the most fun part. So let me, bear with me and let me go over some of these examples on how to calculate your FTE. Both of the examples that I'm going to go forward with are using the original 8-week covered period, but essentially, if you use a 24-week period, you just have to extend how long you're doing these calculations. And this is kind of just a grid that kind of shows you the different types of information that you're going to want to start accumulating. What I do want to note is that it's not just done, here where we say, okay, yep, here's the first week of the covered period and here's my payroll, here's the amount. You have to do this by employee. So you're going to be creating a spreadsheet that's going to show much more details as we have down here, and it is by each employee. But let's start going over what this FTE calculation looks like. So you've got your pay period during the week of April 20th. You've got 15 employees that you're hired that are working more than 40 hours a week. Those are automatic 15. You've got 4 part-time employees, and accumulated over this pay period, which is for 1 week, they worked 100 hours. And so you're going to take 100 hours and you're going to divide it by 40, which is going to get you to a full-time equivalent of 2.5. So for this week of April 20th, you're going to have 15 and 2.5 for 17.5. Now, just to go over briefly about some of the other details you're going to want to go through in this spreadsheet, you're going to make sure that you need to have the employee name. You're going to have their ID number. You're going to have what they made during this pay period. In addition, there's some other time frames other than what's being paid during the cover period that you need to document some of these, the FTE requirements, and then the hourly wages or salary that they're being paid. And we'll kind of go through some of that a little bit further. You just want to make sure that when you're creating these spreadsheets that it's easily traced back to supporting documentation, whether that's your payroll summaries, your 941s, whatever that may be. You want to make sure that what's in the detail here agrees to some supporting documentation for what was paid to these employees and how much they worked. And also, again, just a reminder that you're going to need to retain these records for at least 6 periods after the forgiveness was granted. So here's kind of where we would go, forward with an 8-week period and continue to, document the employee FTE counts. And so, we've got our first 3 weeks here, and then we've got 5 weeks estimated here, just for sake of showing this on one slide. So here's your full-time FTEs did not change for all of these periods, and then your part-time employees kind of had some various hours, and so here's what their FTEs turned out to be for each of these weeks. And so over here is the total for your part-time and full-time FTEs. So you would add up these, 16.8 times 5, and then these 3 amounts, and that gets us to 136.2, and then you'd have to divide it by the 8 weeks to get your average for the covered period that you've chosen. So we show here there's a 17.1 factor. So Schedule A, this is essentially what the bread and butter of the application is. It's really the most important thing that you need to worry about when you're doing this forgiveness application. It's because this is where you document all of your costs. This is where the FTE reduction calculation is noted. It's where, all of the amounts that go into determining what the forgiveness amount is based off of this Schedule A. And we have various tables here. We've got Table 1 and we've got Table 2 and a possible third table, which we'll kind of go over. But Table 1 is for employees who are making less or who made less than $100,000 on an annualized basis at any time during 2019. Maybe an employee, was paid under that most of the time, and one paycheck, they got a substantial bonus that put them at an annualized basis for that pay period over $100,000. That employee does not belong on Table 1. That employee now goes on to Table 2, which is for all employees who made more than $100,000 on an annualized basis in 2019 at any time. It's not a table necessarily, but Schedule A, line 9, is for reporting compensation of owners. The application does note that if there's more than one owner that needs to be listed there, then you will need to provide a separate table outlining the amounts for each owner. And then the other significant part of Schedule A is the calculation of the FTE reduction if that is deemed necessary. So for Table 1, this is essentially a very basic version of what this looks like. So you're going to have, and like I said before, everything's tracked per employee. So you've got your employee name, Mr. Penn, and you've got their identification number, which I believe is supposed to be the last 4 of their social security number. And then the covered period. So what was their cash compensation during the covered period? And then what was their average FTE count for the covered period for that employee alone? If this was an employee where you reduced their wages more than 25% during the covered period and are unable to prove that you restored that by December 31st, you must put the amount of the reduction applicable for the covered period into this box. For this example, we're going to assume that nobody was reduced by 25% or they couldn't be restored by December 31st. In addition to this schedule here, there's an additional box that would go under this average FTE, and that's going to allow the borrower to put in an amount of FTEs that meet the reduction exemptions that we're going to go forward in a little, or go over in a little bit. Table 2 looks exactly the same, except it's for all the employees that make over $100,000. And so you'll see here that for the 8-week period, they would have been capped at the $15,385, and they had no reduction. It is important to note that these employees they are not eligible for any of the FTE reduction exemptions. And so you won't see this box down here under the average FTE at the bottom to note that there was an exemption. They are not eligible. So if you had more than one owner and you needed to create a schedule or a table for line 9 of Schedule A, this is kind of what it would look like. You know, you'd have your owner or your owner employee, their identification number, and then their cash compensation. We don't necessarily need to include their FTE amount here because they are not part of the FTE calculation for any reduction. So let's get more into that, especially because what we have seen, at least, you know, based on questions from current clients and the outside public, is that the FTE reduction is the biggest concern because, you know, we're not back up and running at 100% to where we were on February 15th, you know, and who knows what that's going to look like by December 31st, but at least now we've got some time, you know. So a lot of people did have to reduce or furlough employees during the time period that we have to look at. And so first and foremost, the safe harbor period started on February 15th and ended on April 26, 2020. April 26th was determined because it was 30 days after the passage of the CARES Act. And so they're considering the safe harbor period. So the first question you should ask yourself before even going down the road of calculating an FTE reduction is, did you reduce your workforce between February 15th and April 26th? If you didn't, great. That doesn't mean you still don't have to document the FTEs in your application, but you can breathe a little bit easier knowing that, okay, I didn't reduce my employee headcounts or, you know, hours, and so now I know I'm not going to have a reduction. So there are now several different provisions or safe harbors that are allowed to exclude yourself from having an FTE reduction based on what came out in the PPP Flexibility Act last week. So you need to be able to document and prove the following: that you were unable to rehire individuals who were employed on February 15th, but were later furloughed during the safe harbor period. So you laid someone off, offered them their job back, and they turned you down. That needs to be documented. It doesn't necessarily need to be in something that the employee signs. You know, you can document, I called so-and-so on this date and they turned down my offer to rehire them. The second one is that because of the workforce currently available to you, you're unable to rehire similarly qualified employees for positions on or before December 31st. You know, what that documentation looks like, there is no clear guidance, but I would think it would be documenting the offers to employees. It would be, you know, documenting the fact that these employees that are available are not similarly qualified for the position you have that's unfilled. And so hopefully more guidance comes out, specifically, you know, kind of identifying what they're looking for there. But really, I think it just needs to be like a good faith effort of making sure that these things are documented. And then the last one, which was huge, especially because we don't know where we're going to be on December 31st, is that you can document an inability to return to the same level of business activity that you were operating at on February 15th due to compliance requirements or guidance that was issued anytime after March 1st through the end of the year that, has standards for sanitation, social distancing, other guidance for worker or customer safety requirements. And so if you really can't get back to that point by December 31st, and you can document that and prove it, then you will not be penalized on your forgiveness amount because of the FTE reduction requirements. But key there, again, document, document, document. Start now. Don't start gathering this stuff at December 31st. If you're going to be looking at applying for forgiveness shortly after that, you need to start making the case now and making sure that you're getting your ducks in a row before you get this application submitted. So let's just say you answered the original question, yes. You had a reduction of employees or your workforce anytime between February 15th and April 26th. So the first thing you need to do is go back to the pay period that included the date of February 15th. And you're going to have to go through your FTE calculation for all employees that were paid in that pay period. So that's one calculation. The second calculation is that you're going to need to calculate your average FTEs during the safe harbor period. So February 15th of 2020 to April 26th. If number 2 is greater than number 1, so if your FTE count was higher at February 15th than it was during the average FTE during the safe harbor period, then you can check that there is no reduction. If that is not true, if you had less employees during the safe harbor period than you did at February 15th, then you're going to have to look at calculating an FTE reduction if you cannot meet any of the exceptions that we just talked about. So what does that calculation look like? Well, first and foremost, the important part is that there's a reference period now. So now forget about your FTE counts for the covered or not covered period for the February 15th and safe harbor period. Now we need to be looking at your reference period and your covered period. And you're going to have to calculate average FTEs for both. But you do get the option to choose your reference period for your reduction calculation. And so the first option, option 1, is your reference period is going to be from February 15th of 2019 to June 30th of 2019. Option 2 is going to be from January 1 of 2020 to February 29th of 2020. And then the SBA came out with further guidance giving an option 3, understanding that there are seasonal employers that don't necessarily, it wouldn't be appropriate for them to use these reference periods as they identified them. And so now seasonal employers are allowed to choose any 12-week period from the period of May 15th, 2019 through September 30th of 2019. The key point here is that you're going to want to go with whatever option period that is going to give you the least amount of FTE counts, because what you want to be proving is during your covered period is that you have met that or exceeded it. And so, if you're not seasonal and you're looking at option 1 or 2, whatever one has the lower FTE count is most likely going to be the one that you're going to want to elect for your reference period. So on Schedule A at the very bottom, there is the FTE reduction calculation if this is necessary and you didn't meet the safe harbor requirements. So what is this calculation? So you're going to look at your average FTE for your chosen reference period, and then your average FTEs from Schedule A, tables 1 and 2, and that is going to be what you look at. So here, back when we were looking at that FTE calculation, we came up with that 17.1. Well, that's during the covered period, what we were paid after we got our loan funds. This 18 FTEs is the example that we're using that was going back to whatever your chosen reference period was. So obviously you can see that your FTEs, your average FTEs during your covered period were a little bit less than your FTEs during the reference period, and you would have an amount that needs to go to line 13 of Schedule A as your FTE reduction quotient. So let's go over some of the other options that you have to maximize your debt forgiveness. Obviously, we all know that there's a part of this that is related to payroll costs. So you do have some options. Obviously, you still want to be, looking at what covered period you want to do, 8 or 24 weeks, depending on the date of your loan disbursement. And then also the alternative covered period if you are biweekly or more frequent pay periods. The other is making sure that you're maximizing this based on the selection of your reference period, which we just discussed. And then whether or not you want to use the simplified method. Other payroll costs that get included in this outside of just gross wages include employer health insurance contributions, including self-insured group health premiums, but you need to exclude pre-tax amounts of employees. You also can include retirement contributions, 401k matches, pension or discretionary profit sharing contributions. And a reminder for these profit sharing contributions, they need to be prorated over the current year contribution, for the covered period that you choose. It can't be the total amount of the contribution that's paid. And then you also can include state employer taxes like SUTA, but the key here is that these taxes have to be assessed on employee compensation. Eligible non-payroll costs, covered rent expense on real or personal property that was incurred before February 15th, meaning that lease agreement better be signed and in place prior to February 15th if you're going to be utilizing these costs. The next one, covered period mortgage interest. So any mortgage obligation that was in place prior to February 15th, you can include the mortgage interest, and you cannot include any principal. And then covered period utility payments. And this is where there's a little bit more gray area. Items like electric and gas and water, even telephone and cell phone, pretty clear, internet access, but where we've had lots of unknowns, lots of questions, we still don't know and are praying for more guidance to come out is related to these transportation costs. They have not specifically defined or identified what's included in these types of utility payments. And so, if you are unsure of these, contact your CPA, your lender, have these discussions if you have some unknowns or have some costs that you think might be eligible under this category. Key point here, all of these non-payroll costs, no more than 40% of the PPP loan proceeds can be used for these without incurring some amount that is not forgiven. The other key point on these non-payroll costs, these must be paid within the covered period or incurred within the covered period and paid before the next regular billing date. So the key here, and we want to be conservative with this, is that we're just going to follow accrual accounting. It's not clear in the guidance. We might have some further guidance that comes out that says, it doesn't matter, as long as it was paid during the cover period, we don't care when it was incurred. But then they do provide that extra flexibility at the end. So you're at the end of your 8 or 24 week period, you have some additional costs that, were incurred during the cover period. As long as you pay those by the next invoice billing date, then those can be included in your cover period. And with that, I'm now going to turn it back over to Angie, and she's going to start going over some of the Q&A.
Thank you, Megan. I'll turn my camera back on. So I do have a couple questions that I wanted to go through, and then also one quick clarification that was noted. So in the first one, I'm going to kind of answer this one out of order because it had to do with the slide you were just on, and that had to do with the cost when it comes to utilities. And so just having an example, if you have your Northwestern Energy bill, and so say your covered period ends on July 31st. If you receive in August a bill from Northwestern Energy, but it was for the period prior to July 31st, then that would be included within that covered period. The other thing, though, that you have to be aware of is that if you have a bill, a lot of bills don't go on a typical monthly timeline, but also a lot of these loans covered periods are not on a first of the month. They start on April 12th versus April 1st. And so because of that, a lot of these bills are not going to coincide exactly with the covered period, excuse me. And so because of that, if you receive a Northwestern Energy bill that was ending on July 31st, but your covered period went only through, say, instead of July 31st, your covered period went through July 20th, then you need to make sure you're prorating that bill so you're only including 20 days of it and not the full number of days. So one other question, a couple of these questions, Megan, I'll have you answer, and then I'll let you know which ones I'm going to have you answer, and then I'll answer some as well, just so we can do a little bit of both on this. And so the first one, I'm going to have you answer this one, Megan, is if a covered period goes to the 24 weeks, how does it affect the amount that is allowed for those making over $100,000? Is it now 24 prorated weeks rather than 8? Or if you make over $100,000, are you still only allowed to have the 8-week amount of payroll for those making over that amount?
So for those of you who haven't read the PPP Flexibility Act that came out last week, it was a 2-page document that essentially struck a bunch of the wording from the original CARES Act and replaced it with these changes. The original act stated that employee compensation prorated based on the covered period was not allowed in excess of $100,000. So from my interpretation, with not seeing any other SBA guidance that has come out stating that, you would use the 24 out of 52 weeks for those employees.
Thank you. One of the other questions, this is somewhat of an IRS type question, and so I'll let you know what the answer is as of now, but that it might actually change as well, is if forgiven, can you still deduct those expenses that were forgiven? And as of now, the IRS is saying that no, you cannot deduct those expenses. However, we do expect there to be more guidance coming on this potentially. I know that there are some potential changes that they would expect to go through Congress to urge them to allow those to be deductible. But as of now, the IRS is saying that no, you cannot deduct those on your tax return, and they're considered non-deductible expenses at this point. So if further guidance comes out on that, we will let people know that that is what it is as of now, at least. Another question is, are you allowed to prepay non-payroll related costs included in the forgiveness calculation? It specifically does state that mortgage interest is not allowed to be prepaid. The final rule does not specifically say you cannot prepay rent or leases or utility payments, but we would not recommend it. There isn't any guidance out there specifically documenting whether or not you can do that. However, at this point, I would think from a conservative standpoint that those are not going to be allowed as well. And we're hoping that further guidance and more updates from the SBA in Q&As is going to cover that in a little bit more detail. Another question is, when does an EIDL advance reduce forgiveness amounts? So for those of you who have received EIDL loans, which is the it's the EIDL loans that also come from the SBA. So when they first came out with this program, before they came out with the PPP program, they had these EIDL loans. And what it was an economic impact loan that what you could do is receive up to $10,000 in these loans that was forgiven, and then receive later on potentially further guidance or further lending amounts. So, and those loans are a little bit different than the PPP. They're over 30 years. They have over 3% interest rates. They were still a way to kind of give emergency lending out that came directly through the SBA. It didn't go through lenders. However, one of the things that they came out with when they came out with the PPP program is they said if you already received an amount of that $10,000 from your EIDL loan that was forgiven, you can't have that forgiven and then also get a full amount of PPP forgiven, because they felt that then you were getting both and it was too much. But what they said they would do is roll that forgiveness piece of the EIDL into your PPP, because of the fact that the interest rate on the PPP is 1% versus the 3.25%. It's better to have it within the forgiveness not granted for the 1% than the higher interest rate. So, but just be aware that that's something that they specifically noted, that the SBA will deduct that when they are doing it if you have both. A couple others is, does the lender or SBA determine final forgiveness? And as Megan noted previously, it's a little bit of both. Both of them have a specific amount of time they get to review the forgiveness application. The lender gets 60 days, and once they determine they feel it's, whether it's 100% forgivable or partially, they then approve it from their standpoint and submit that to the SBA, and then the SBA has an additional 90 days to either agree with the bank, or they can come back and either ask for more information or maybe even reverse what they feel is forgiven or anything like that. So ultimately it does end up with the SBA, but also the other thing is that she mentioned was then they do have 6 years to come back and audit it. So once you do get forgiven, yes, that is a great sigh of relief, but just make sure you're keeping your documentation on that in case they do come back later to audit. There were a couple other quick questions, and then there are some more, it looks like, that are coming in right now as well. And so, will my loan forgiveness be reduced if I laid off an employee and offered to rehire them? I think that Megan covered that pretty well, just in the fact that, you know, no, it won't reduce it if you try to rehire them. One thing though, just to kind of add as an extra point, is if that person was furloughed or laid off and they were collecting unemployment, and then you offer them their job back and they decline, you are required to then let the unemployment office know that you did attempt to rehire them, so they can't still stay on unemployment, because of the fact that if they were offered the job back and they just declined it for whatever reasons, that they need to be notified as well. And so that is something else that they do note in the act, is that that does need to happen. A couple other things that came in is our employer payroll taxes, Social Security, and Medicare deductible. And Megan, do you want to answer that question as well?
Sure. So that answer is no. The employer portion of any of these payroll taxes is not to be included. The employee portion is built in to their gross wages. And so any amounts paid for the employee portion don't get added on top of the compensation amounts, because those are already included.
So there is a question here too about the difference between incurred and paid. And so I'm going to ask this one to you as well, Megan. I have seen some language that states payroll costs are included, that states payroll costs included are those incurred or paid during the covered period. Our fund date was April 14th, and we had a payroll on April 15th covering April 1st through April 15th. What are your thoughts on including this, since it was paid during the covered period?
My word of caution, because we do hope that further guidance will come out really defining this for us, is that I would be careful, even though it was paid during the cover period, by including anything more than that April 15th and 14th dates. Hopefully they'll come out and make this more specific, but we're recommending to people now just to kind of follow the accrual basis of accounting. That being said, it is not clear, because they're making it sound like it's either paid and then you can also incur the amounts at the end. So as long as you paid something during the covered period, it should be included. But we don't really know if that was their intention or not. And so, you know, for now, I would document just the 14th and 15th since those are included in the covered period. But again, hoping for more guidance.
And then another question here is for you, Megan. I'll have you answer this one as well. Is if you opt for the 24-week period, but rehire the target level of FTEs before the end of the 24-week period, can you close out and apply for forgiveness earlier than the 24-week end date?
They haven't specified whether you can apply for forgiveness sooner than the 24-week end date, but as long as you can prove that prior to December 31st, you were able to reinstate that FTE count and document it, then I think you wouldn't have to worry about any FTE reduction. What might not be clear, another question that just automatically pops into my head is that, well, what if you reinstated them at week 16, but week 22, you dropped them back down again? I don't know. I don't know what they're going to look at. You know, I don't know, because FTEs are going to be included on the calculation through that 24-week period. I would think that you would need to reinstate them and then keep them at those levels. But again, I don't know for sure. But the guidance or the act itself does say you can reinstate prior. It's just that you have up until December 31st to do so.
And because of the fact, I'll give Bruce Kramer was great enough to chat in what the new bills coming through Congress are that have to do with the taxability. And so there are 4 specific bills already. I knew there was at least one. I didn't realize there were 4 of them at this point. So in case anybody would like to have those, it's Senate Bill 3612, House 6821, 6884, and then also Senate Bill 3596. So thank you for giving those to us, Bruce. That's appreciated. And then a couple other questions really quick. It looks like we still have plenty of time, so I'll kind of go through a few more of these. The first or the next question is, has there been any direction or any thoughts on how the funds that are not forgiven can be used? And can they be used in any way, or do you have to use them for something specific? There has not been any guidance indicating whether or not you are required to use the non-forgiven funds for anything specific. Based on what it is and what is interpreted, the funds that they need to be used for the businesses, for what your operations are. And so I don't think that there's going to be any restrictions. What I would say is look into the actual loan document you signed to determine if it states in there anything about that. If it doesn't, I don't believe that there are going to be any requirements. They're not going to be tracking what you didn't get forgiven for so much as being more concentrating on what you do get forgiven on. And so there's one other quick question here that I'm going to send back to you, Megan. It says, can you add healthcare paid by employer and 401k match amounts to the employees making over $100,000? So then it would make it more than $100,000 for you to count them for.
That is correct. You can add healthcare paid and 401k amounts on top of the maximum compensation of $100,000. So it would make them more than 100, but the $100,000 limit is strictly limited to the gross wages.
And then another one, it asks about, do lease payments for equipment qualify? And the answer to this is yes. So payments on business rent obligations is considered for real or personal property under the lease. The only thing you have to make sure of is that the lease was in place before February 15th. So what they're trying to make sure thereof is that you're not going out and trying to lease a bunch of equipment now that you didn't have in place as of February 15th, just to make sure that you have some expenses to cover it. And then, you know, maybe, especially if you're trying to do quick month-to-month leases that you'll get rid of after the fact just to spend the money or something like that. They want to make sure that what they're trying to say is, we want to get you back up to where you were on February 15th. So if there was something around on February 15th, then it can apply to what you're doing now. You can't add in new things when it comes to what those forgiven amounts are. One of the other thing is, do borrowers need to make monthly payments if their forgiveness application is pending with the SBA, and how is it reimbursed? And Megan, do you want to answer that question?
I can. That kind of changed a little bit with the act last week. As far as people who are applying for forgiveness, you will not need to start making payments because your deferrals go through the date that the forgiveness amount is sent to the lender or determined by SBA. So until they've made some sort of determination and paid the lender, you are not obligated to make any payments. My understanding from reading this morning is that the date that you apply for loan forgiveness is kind of when the date starts ticking for accrual of your interest. And so if they come back and say, you know, you have a partial amount that's not forgiven, you will be responsible for interest accrued back to the date of your loan application. If you decide not to apply for any forgiveness, your deferral of payments is for 10 months following the date of the end of your covered period.
Okay, thank you. So another one is, if your employees are international and live outside of the United States, is it possible to discharge their payroll as well? And the answer to that one is no. The employees have to have their principal place of residence inside the United States. And then I have one final question, at least from my side, and then we'll see if there's any more that come in after this one. And so, what if a sole proprietor has not yet filed their 2019 tax returns? As I'm sure most people know, a lot of the tax deadlines did get extended. However, the 2019 return for a sole proprietor is driving what your forgiveness portion of the loan is. So you cannot apply for forgiveness until you file your 2019 tax return. So you need to make sure, if you have not yet filed your 2019 tax return, you do as soon as possible, because if not, that will hold up the ability for you to apply for forgiveness for your loan. And then it does ask another one, and I don't think I've asked them this, just can you pay off the unforgiven amount right away, or do you have to make payments? And at this point, we don't think there will be any issues with you wanting to pay it off immediately, even though if you look in their loan documents, it's no different than any other loans. It'll tell you whether or not there's prepayment penalties. And in the loan documents that I've seen, there are no prepayment penalties. So if you get to the end and say you have a $100,000 PPP loan and $25,000 of it does not get forgiven, you can pay that back immediately, and then you don't have to worry about paying it off over a 2-year period or a 5-year period. You can just pay it off right away, so you don't have to worry about paying it with interest along the way or anything like that. Especially if the amount that you don't get forgiven is really small, then I don't think you'll want to have it sitting there and, you know, getting charged. Even though it's only 1% interest, it's still interest, and you don't want to have to pay that if you don't have to. I think the good thing about what came out of Congress last week is that is hopefully going to be enough where a good chunk of people who were concerned before that they were not going to be able to get the full loan forgiven now really will, because of the fact that it really gave you a lot more time to be able to spend the cost, and more flexibility with saying that you can use up to 40% for non-payroll costs, where before it was 25%, which was a lot more stringent. So hopefully, because of these new changes, there won't be as many issues with people who won't have the ability to have it forgiven. One other thing, and this just came in as a question as well, is yes, we will send out the slides from today. We'll send them as a PDF, so anybody who registered will receive a set of the slides from today. And we will send out a recording as well, just so you are aware if for some reason you need to rewatch a part. try to walk through part of the calculations or anything like that. And so we will send both of that to any of the attendees. And then I also did talk to Jim Brown, and he said he will send it out to the members as well, who a couple of them were unable to attend during this time frame, but really wanted to be able to still see the recording. And so he will send that out as well. I'm looking to see if I missed any questions. Did you see any other questions come in, Megan, that I may have missed along the way?
Nope, I think we answered them all.
Okay. So I want to thank Jim Brown and the Montana Independent Bankers again. We really do enjoy working with them, being an associate member. We've done a lot with Jim and a lot of the people who work with him, and we really appreciate everything he does. And they typically have a conference coming up here in the next month that we attend. And so with everything that's going on, unfortunately, knowing they're not having that conference, we were disappointed we wouldn't be able to see all the people we typically get to see at that conference. And so I'm happy that we were able to find a way to at least have some contact with the members and really be able to help a lot of you out as much as we can. Just so you know, anything that you guys might need, I'm going to put up on the last slide here, our email addresses and our phone numbers there as well. If there's anything that you need that you think of after this, please feel free to reach out to either of us with any questions. As things come out, as there's more information, we will be sending out information as well if more SBA Q&As come out, clarifying some of the items that there still needs to be guidance due to gray areas. We're hoping to get some of that information out as well. And so just know that even though there's a lot of information out on there right now, we do expect a lot further guidance coming out in this. And so I just want to, again, say thank you to everybody for attending. If there's any questions or anything you need, please let us know. And otherwise, we'll let you guys go a little bit early. And thank you again.